Legendary investor Lee Cooperman is the chairman and CEO of Omega's family office. And Lee, I think the last time I talked to you was the beginning of July. So we're going back a couple of months here. At that point, you said that you were a fully invested bear. Are you still feeling that way?
Absolutely. I would say that the cyclical conditions are not ripe for a big decline. Generally big declines come about because of recession. We're coming out of one. We're not going into one. We have a hostile Fed, which we don't have. I think I'm critical of the Fed. I think they've been too easy. I think they're wrong on inflation. 65% of a typical business cost is labor, and labor is not going down. I think the transitory part of inflation is some of these commodity costs. And I think, you look at the world, it's kind of upside down. If you lined up 100 economists and asked them what is the potential real growth of the U.S. economy over time, the response would be centered around 2% real. If you're a bear, you say 1.5. If you're a bull, you say 2.5, but around 2% real. We're growing at 3 to 4 times potential, yet we're persisting in holding interest rates at near zero. Okay. The second observation is we've already injected into the economy $1 trillion of stimulus in excess of wages lost. And our big government president is trying to get another few $1 trillion approved, which I don't think he'll get approved. So we're pulling demand forward, and I think this has created an artificial situation. There's nothing that's overpriced against interest rates where they are today. Well, there's some things overpriced. They're crazy. I call that the Robin Hood market. But by and large, most companies are not overvalued. I went back and I looked at the excesses of 1972 and the excesses of 2000, and you're talking about totally different multiple structure than we have now, much higher multiples, and interest rates were over 6% in 10-year governments. You have a 10-year government at 1.34. There's nothing overvalued. So that's a cyclical view. But long term, I think we've been eating our seed corn. We're pulling demand forward, and I have a lot of things that concern me. I don't like this.
That's an argument for being invested right now. What would actually change your tune? What would make you say, okay, time to get out of some of these?
Fed speak. Listening to Fed speak. I'm looking at inflation. I'm looking at market action. I'm looking at the action of gold and Bitcoin, the dollar exchange rate, and interest rates overall. I'm watching a lot of things for a signal to change. And the market structure is broken. So when there's a real fundamental reason for the market to go down, it's going to go down so quickly your head's going to spin. There's no stabilizing forces in the market now. It's all run by machines. So, I would say those are things I'm watching, mainly Fed speak, inflation. Like I said, 65% of business costs are labor, and labor is not going down unless you're going into a recession. And we're not going into a recession anytime soon. And that's at least a year away, maybe longer, who knows. And that's kind of my story, and nothing has changed. I'm finding a lot of things to do in the market, which is encouraging. My biggest position is a very contrary view. I came into the year with overweighted energy. I'm even more overweighted now. And I look at the natural gas situation. Storage levels are, way below historical norms. And the price of natural gas has moved up quite dramatically. And we have about 7 or 8 companies in the natural gas business that are coining money now, generating enormous amounts of free cash flow, paying down debt, paying out big dividends, buying back stock. 2 of my favorites, Tourmaline up in Canada, Paramount up in Canada, Cabot Oil and Gas in the Marcellus, and Devon Energy Transfer, Enterprise Products, 2 MLP type companies where they're paying big dividends, Pioneer Natural Resources. So we have a very big exposure to energy. And then I find a lot of individual stocks that are very cheap. Citibank at 9 times earnings and discount to tangible book value. Cigna buying back a lot of stock, 8.5 times earnings. Athene merging with Apollo, 7 times earnings. And then I have the standbys, Google, Amazon, Microsoft, Facebook, Fiserv. I'm very high on Fiserv. This is a 20 multiple stock that deserves to be selling at 25 or 30 times earnings in today's market. So, and my favorite idea is very ironic, is a bond. I think bonds are totally mispriced. If you look at bonds, it's really amazing. Historically, the 10-year U.S. government bond is yielded in line with nominal GDP. Okay, nominal GDP on a trend basis is probably 4%, This year probably be, I don't know, 6 or 8%. Rick Reeder, who I have a lot of respect for, is on the program. He could talk to the bonds. But, we're talking about a big negative interest rate in the 10-year and in the short-term paper. And I think it's a bunch of academicians, running monetary policy around the world. This negative interest rate stuff is ridiculous. The idea of buying 10-year German bonds and getting less back in 10 years than you give them today, I don't get it. I don't get it. I really don't get it at all. And I was saying that my favorite idea is a bond, but it's not an investment grade bond. It's a triple C bond. It's a company called Legato. They have first lien paper, 15.5% trading at 97. I think it's just very attractive, a little complicated, so I won't take too much time talking about it. But I find lots of things to do. But I must say I have a weary eye on the market. I don't like monetary policy. I don't like fiscal policy. I don't like the attack of the wealthy. And it's not because I'm wealthy. I'm giving all my money away, so I could care less. But, I'm a capitalist with a heart. And I think that this constant attacking of wealthy people is very disturbing to me.